Hi everybody, welcome back to my channel. My name is Munya. I'm an accountant, a tax practitioner, and a business coach. Today, I would like to talk to you about pricing. Pricing is everything in business. There are some people who are not making enough money or profit because of their pricing strategy. So we need to look at what are some of these strategies that we can use and implement in our business so that at least we can increase our revenue, we can increase profitability, and it will lead to the success of our business. So when we talk about pricing, or when you talk about a price, this is an amount of money you're going to set on your products or service. So it's how much you're going to charge your customers in return of products or services that you offer them. This is a critical area because business is about profits. If you are constantly making losses, then you are not in business. A lot of times the pricing strategy might be wrong. There are many business people who are in business and they're just making losses. Why? Because they are pricing below the cost. Mostly because there's no record keeping. So for you to come with a pricing, definitely there are so many variables that you need to consider. You need to consider your costing, which is the most. How much are you going to get this product for? What are the expenses that are involved in this product? And then how much are you going to charge after you've accounted for all those costs? But the problem is when you are not managing the cost, when you don't know how much is involved in you getting to that product, in you getting to the service, there's no way you are going to charge correctly. Let's look at some of the pricing strategies that I have come up with or that I'm interested in. There's competitor-based pricing. When you are using this pricing strategy, you always check your competition. How much are they pricing the same product? You have to do your research, your market research. You need to know your competitors. You need to check the products that they are selling. That are they the exact products? So when you are comparing, it should be like and like. There are some times where a lot of people miss it when they look at someone's product and they think they are offering the same product, but there is a difference, maybe in terms of quality. Like in the clothing industry, you can find that there's an original product and there's a fake product. So if you are going to compare your original product with the fake products, obviously you're going to be misled on the pricing because these people are not your competitors. They are in a different market. So you need to go to the specifics of the products and compare it. Know exactly that this is the exact product that you are offering. So when you are using this strategy, look for the high price in the markets, look for the lower price, and then average and price yourself there. So you should also not sell yourself too short or too high. You need to understand your market as well. Because there are some people who do not buy when something is cheap. They are willing to pay more for the same product. A lot of people actually say go lower than the low price. Then my question is still, will you still make a profit? If you're still going to make a profit by going lower, go low but not too low. Because when you also go too low, people will start wondering, why is this cheap? Maybe it's not the exact product. Maybe there's a problem with the product. So your pricing strategy needs to be in line with your competitors. Not too low, not too high. So you need to do your research. Have time. Don't just take two competitors and that's it. Have a variety of competitors in different locations as well. So that you have a fair market to analyze on. The second one which you can use is bundle pricing. So when you are using some of these pricing strategies that you are going to implement, they are also for you to move yourself. Because when you are having products and you are not moving the products, you are remaining with the stock is not moving, it means you are losing money. So you also need to make sure that your stock moves. So some of the strategies that you implement are for you to move the stock. So when you do bundle pricing, this is when you pay your products and sell them, let's say, for a price of 1. It helps you to move your product faster. For example, you can say buy 2 for, let's say, 100, buy 1 for 65. So someone might consider to buy the 2 items because it's going to be cheaper. Or when you mix different products, but the total amount is less than if they were buying an item which is sold as a single item. So this is going to make sure that you are going to push volumes, because people are going to buy, instead of someone saying I'm going to buy only 1 item, they are motivated to go for 2 items. There's also what is called dynamic pricing. This is when you change your prices when there is demand due to season or time of day. For example, heaters or warmers in winter, or Uber during peak hours. So when you are doing dynamic pricing, you are not going to be set on one price throughout. You are going to check the demand and change based on the demand for that particular day, for that particular week, or for that particular season. So if you have checked with Uber, what happens if the weather is so bad, where let's say it's raining or it's off peak, it's during peak hours, the prices go up. When it's off peak, the prices go down. So that is dynamic pricing. So you can also check the seasons as well. If it's winter, you know the winter items are higher. If it's now getting to summer, you start reducing so that you can offload the stock. So this is one of the pricing that you need to be aware of. But with dynamic pricing, it means you are always checking on the variables quickly so that you adjust your pricing. There is also discount pricing. So with discount pricing, you can do it as quantity discounts, seasonal discounts, or cash discounts. So when you are using quantity discounts, you are going to give your customers a discount based on certain number of items they buy. This encourages people to buy more items than 1 item. For example, 5 or more items, it is 30 Rand an item, but less than 5, it is 40 an item. So people are going to be motivated to buy more items than buying fewer items because of that quantity discount. So this is going to help you to push volumes and still have a good profit if it's calculated right. Seasonal discounts. This involves reducing a price to encourage the purchase of an off-season product. So like what shops do during winter, during summer, when it's like spring to summer, they start having winter sales. They start offloading whatever the things for winter. They also do the same when you're approaching winter. They also start offloading the summer items. So this encourages to clear the last season stock. So that one you can also implement. There is cash discounts. This is an incentive for people to buy cash, especially when your clients are buying on credit. So when you give them a cash discount, you are going to say, if you buy on cash, we are going to give you 15%. If you 15% off. But if then off, or it's going to be 100 Rand cash, but if it's on credit, it's 130 Rand. So this encourages people to buy on cash. And what it does, it's going to increase your revenue. So you are going to get more money immediately because people are going to opt for cash sales than for credit. You look also for another pricing method, which is penetration pricing. So when you are using the penetration pricing, this is the pricing which you use to attract customers, especially when you are new into the business. You are going to offer lower prices so that they come to you and they start knowing you. Because most people they buy based on price. So the lower the price, the people feel attracted, or if you are going to offer an opening sale or a discount of some sort, they are going to be attracted to come to buy from you. And they end up knowing you. So you have already positioned yourself. But be careful when you use this penetration pricing. It should not be too low, such that when you increase the price, customers will run away. It should be reasonable and still make a profit for you. At the same time, you are benefiting that people are going to know you. I'm going to look now for the last one that I want to cover, which is the one that I talked about initially as a summary, which is cost plus pricing or markup pricing. When you are using this, you need to determine the cost associated with the product and then a certain percentage of markup to come with a selling price. So for this method to be effective, you need to know your expenses because you need to account for everything. There are so many people who sell a product without making the profit they think they're making because they are skipping certain costs, certain expenses. For example, you are using airtime when you are in business. You're going to call clients. Maybe you are delivering, you're going to use transport, you're going to use fuel, you're going to use your bundles and all those things. But some people, they forget about this cost and they just look at their cost price in terms of purchasing the product and they put a markup. But they forget about the other expenses, which are also very critical in coming up with the selling price. So you need to calculate all the expenses and then add a profit on top. So what happens here is, first of all, you need to decide the profit percentage you want. What is the markup you want? And to determine this, you need to go back to your market and understand what are the markups that people put on their products in the market. How much is it? Or what are the prices that people are actually selling? So if they're selling at this price, what is my profit percentage? So when you have decided what is the profit percentage you want, then you need now to make sure you put together all the costs and all the expenses. Depending on your type of business, it varies. So some costs are not accurate because you cannot apportion them to one item because they cover a lot of things. Let's say data. There's no way you can go into apportion to say this dress is going to consume so much data and this is the cost in relation to data. But you're going to average to say for this order of so much, this is the expense, this is whatever, and now average. So let's say you have a total of 100 items and you bought them for 1,500. What it means is you're going to divide the 1,500 divide by 100. So the cost of one item is going to be 150. So let's say you want to get a profit of 50%. That's the profit margin you want. What you're going to do is you're going to say the 150 for each item times 1.5. So if you want 50%, you multiply by 1.5. If you want 25%, you multiply by 1.25. If you want 30%, you multiply by 1.3, like that, and so on. So now, with my example of this item that costs 150. So you say, okay, it's 150. If I want a profit of 50%, I'm going to multiply by 1.5. And the total that I'm going to sell this item is 225. So that is how we are going to do your costings. If you are going to use cost plus pricing. But remember, it's not about the cost of the item, it's the expenses. So you are going to put everything that relates to that 150 items, that 100 items, put all the expenses, now come up with an average cost for each item, then put your markup. Then you come up with the pricing. So it's not like you are going to use one method. When you are coming up with different pricing strategies, you can use more than one pricing strategy on your business. This month you can do the discounts, you can do whatever. The next time you are doing another, you can also combine together pricing strategies. As long as the outcome is for you to make profit, to increase your profit, to increase revenue to your business, and your business continues to be successful and you have cash flow in your business. Thank you so much for watching. See you again next time.